This explainer combines non-exchange revenues with expenditures and expenses strictly because the CPA exam tests them together. It builds directly on the government-wide versus governmental fund financial statements explainer, so measurement focus and accrual differences will not be re-explained here. We need to immediately lock in the core principle that's going to govern absolutely everything we do today. Listen closely. Governmental funds rely on current resources and modified accrual, where revenues must be available and outflows are expenditures, while government-wide statements use economic resources and full accrual, where revenues are earned and outflows are expenses. You have to burn this exact divide into your memory, because every single question you face on this topic hinges on knowing which side of this divide you're operating on. It's the absolute engine for the bar exam, and if you lose sight of it, the examiner will trap you. To guarantee you extract the right points on exam day, you must strictly apply a 4-step thinking framework to every single scenario. Don't try to shortcut this. If you jump straight to classification without checking the statement type, you're going to lose points. Here's the sequence. Step 1, identify if you're dealing with a revenue or an outflow. Step 2, identify which statement the question is actually asking about. Is it a governmental fund or the government-wide statement? Step 3, if it's a revenue, apply the specific timing rules we're about to cover. And step 4, determine the final classification. We're going to run every example today through this exact filter, because strict adherence to this process prevents unforced errors. Let's tackle revenues first. In governmental accounting, you're frequently dealing with non-exchange revenues. That's where the government receives value without giving equal value in return. There are 4 triggers you need to know, focusing purely on their recognition logic. Number 1, derived tax revenues. These are derived from an underlying exchange transaction, like a sales tax or an income tax. The logic? The revenue is recognized when that underlying exchange actually occurs. Number 2, imposed non-exchange revenues, like property taxes or fines. The government is imposing a tax on an act or an asset, so revenue is recognized when the government has an enforceable legal claim. Number 3, government-mandated non-exchange revenues. This is typically a grant from a higher level of government requiring the lower government to perform a specific program. And 4, voluntary non-exchange revenues, like optional grants or private donations. Now, for both mandated and voluntary grants, eligibility requirements are what drive the recognition. Applying step 3 of our framework requires mastering timing rules. Let's make this abundantly clear, because eligibility is the absolute gateway. Eligibility requirements dictate if you can recognize revenue at all. Have you met the time restrictions? Have you incurred the allowable costs for a reimbursement grant? If not, you have 0 revenue. Without eligibility, nothing else matters. Availability, on the other hand, strictly applies to governmental funds and dictates when you recognize it. Is it measurable and available to pay current liabilities? Meanwhile, the government-wide statement ignores availability entirely. It recognizes revenue when earned, regardless of cash flow timing. This brings us to accuracy lock 1. Availability is an accrual criterion tied to the transaction year. It is not just whatever cash arrived this year. Examiners love to trick you by presenting cash received late that actually belongs to a different transaction period. Think of it like a strict bouncer at a club's closing time. Cash collected within 60 days after year-end is allowed in because it belongs to that prior year's transaction. It ties the cash back to the event that actually generated the revenue, ensuring your current resources match the liabilities they cover for that specific period. Don't fall for cash basis thinking here. Availability is strictly an accrual concept. Let's put this to the test with City of Greenfield Scenario 1. We have a derived revenue, $200,000 of taxable sales occurred this year. Greenfield collects $180,000 during the year, or within 60 days after year-end. The remaining $20,000 isn't collected until month 4 of next year. Applying our framework deliberately, for government-wide statements, the underlying exchange happened this year, so the city earned the full $200,000. Simple enough. But for the governmental fund, only $180,000 is available within that 60-day window. So why does that remaining $20,000 become a deferred inflow of resources on the fund level? Well, because the underlying economic event happened, but the cash simply missed that strict 60-day availability window. It's legally owed, but it's unavailable revenue for the current period. Moving to Scenario 2. I want you to focus purely on the exact calculation that gets us to the available $295,000 figure. Greenfield has a $300,000 imposed property tax levy. They collected $280,000 during the year, plus another $15,000 within that 60-day window after year-end. You have to actively add the current year collections, the $280,000, and the 60-day post-year-end collections, the $15,000, together to arrive at $295,000. That is your strictly available amount. Examiners will test your ability to execute this exact arithmetic without hesitation. Let's see the full picture for Scenario 2. The $300,000 property tax is an imposed revenue. Government-wide reporting ignores availability completely. It reports the full $300,000 as revenue right now, net of any estimated uncollectibles, because the city has an enforceable legal claim. But the governmental fund has to adhere to modified accrual. It reports only the $295,000 we just calculated as current year revenue, because that is what's actually available to spend. The uncollected remainder, that $5,000, is trapped on the balance sheet as a deferred inflow. Remember, this $5,000 is a deferred inflow specifically because it failed the availability test, not the eligibility test. It is legally owed to the city, it just wasn't collected in time. Now for Greenfield Scenario 3, a voluntary $150,000 advance reimbursement grant. The cash is received right now, but qualifying work doesn't begin until next year, meaning no work has been performed yet. This scenario results in zero revenue across both statements. Why? Well, let's repeat our core principle. Governmental funds rely on current resources and modified accrual, where revenues must be available and outflows are expenditures, while government-wide statements use economic resources and full accrual, where revenues are earned and outflows are expenses. Timing rules dictate this outcome across the board. The eligibility requirement actually incurring the allowable costs for the reimbursement has not been met yet, and no eligibility means no revenue, regardless of the statement type. Which leads directly into a massive examiner trap. This is accuracy lock 2. Unearned revenue does not equal a deferred inflow. You have to keep these strictly separate in your mind. Examiners will explicitly offer deferred inflow as choice A to trick students who see cash collected in advance. In our grant scenario, advance resources with unmet eligibility requirements, like those unspent reimbursement conditions, are unearned revenue, which is a true liability. A deferred inflow only applies when all eligibility is met and just a time requirement or availability constraint remains. If only a time requirement remained on that grant, it would instead be a deferred inflow. Never label a failed eligibility advance as a deferred inflow. Ever. Okay, we've conquered revenues. Now, let's pivot to the direct comparison block for outflows. In governmental funds, the focus is purely on available resources and short-term payment. Therefore, outflows are strictly labeled expenditures. Conceptually, an expenditure means using up a current financial resource. This includes immediate cash outlays for things like buying capital assets or paying down debt principal. In sharp contrast, the government-wide statements take a long-term economic view. Here, outflows are strictly labeled expenses, which means consuming an economic resource over time, like depreciation. So the classification between expenditures and expenses is driven purely by the statement type you're analyzing. Before we look at our final example, lock down accuracy lock 3. Proprietary funds, which are your enterprise and internal service funds, always mirror government-wide accounting. Always. They operate on economic resources and full accrual. Therefore, proprietary funds strictly record expenses. They never, ever record expenditures. If an exam question asks you about an internal service or enterprise fund and offers an expenditure as an answer choice, that is an immediate red flag. Eliminate it without a second thought. Let's run our final scenario, Greenfield Scenario 4, through our framework. The city buys an $80,000 truck with a 10-year life. Step 1, we know it's an outflow. Step 2 and 4, let's split it by statement. The governmental fund cares only about the current financial resources being used right now, so it records an immediate $80,000 capital outlay expenditure. It does not record the truck as a long-term asset, meaning the governmental fund balance sheet is going to show zero for this asset because the financial resource was entirely expended. Conversely, the government-wide statement takes the long-term view. It records the $80,000 asset on the balance sheet and then recognizes an $8,000 annual depreciation expense on the statement of activities over the truck's 10-year useful life. As we wrap this up, I want to leave you with a final provocative question that will dictate your success on this entire exam topic. What drives revenue and what drives classification? To answer this, we cement our core principle for the third and final time. Governmental funds rely on current resources and modified accrual, where revenues must be available and outflows are expenditures, while government-wide statements use economic resources and full accrual, where revenues are earned and outflows are expenses. Timing rules drive your revenue recognition. The statement type drives your classification. On the exam, understanding the placement of these items is far more critical than complex calculations. Keep this framework rigid. Timing drives revenue, statement type drives classification. Master exactly where you are on the map, and you will never fall for the examiner's traps.